Hey everyone, Kelvin here. Tired of losing money in the stock market? In this video, I'm going to review a powerful 6-step system to help you find winning stocks and ditch the guessing game for good. But beware, even with this system, most folks mess up at the very last step. Watch all the way till the end to avoid this costly mistake and build a winning portfolio together. The crucial first step: determine your investment goals. Imagine you're planning a dream vacation. Would you blindly book the cheapest flight? Or would you consider your priorities? Maybe you crave an adrenaline-pumping adventure, so skydiving in New Zealand tops your list. On the other hand, perhaps relaxation is your ultimate goal. Therefore, a luxurious beach resort sounds perfect. The point is, your vacation style dictates your destination, and the same logic applies to investing. Just like there are different vacation styles, there are various investment goals. If adventure is your middle name, you might be drawn to younger, high-growth companies. These businesses might not have established earnings yet, but their potential for explosive revenue growth might outweigh the risk. However, if you prioritize income generation, you might be drawn to companies with strong dividend yields, backed by solid cash flow and consistent earnings. Lastly, for investors who prioritize stability, seeking well-established businesses with proven track record would be key. Once you've identified your investment goals, the next step is to find companies you understand. When you buy a stock, you essentially become a part owner of that business. Would you take the leap and buy a whole company without understanding its core business and how it makes money? Even if the company has a fantastic management team, how can you truly know if they are doing a good job? Investing in companies you don't understand is akin to gambling and setting yourself up for potential failure. Analyze their business model and financials to see if they can consistently cover expenses and generate profit. Also, is their business model sustainable in the long run? These are just some crucial factors to consider before investing. Now that you've got a solid understanding on the companies you want to invest in, next is to uncover their competitive advantages. Having a strong business model and financials is only the beginning. In the real world, companies often operate in competitive landscapes. So, what exactly gives a company that extra edge over its peers and allows it to succeed in the long run? That's exactly what we need to uncover. Companies like Nike benefit from strong brand recognition, allowing them to command premium prices for their products. On the other hand, companies like Walmart achieve a cost leadership advantage through economies of scale. Their massive supply chain enables them to purchase goods in bulk at lower prices than their smaller competitors. Innovation is also another key factor. Companies at the forefront of innovation, like Tesla in electric vehicles, can disrupt the entire industry and capture significant market share. The key is to identify what competitive advantages your chosen company possesses and measure how they stack up against their competitors. The next step is to determine fair valuation. Legendary investor Warren Buffett famously once said, "The critical investment factor is determining the intrinsic value of a business and paying a fair or bargain price." Just because a company boasts a strong competitive advantage doesn't automatically make it a good investment. If the stock price is significantly inflated and doesn't reflect the company's true earning potential, you might be looking at an overvalued investment. Your goal in this step is to look for fair or undervalued hidden gems. Here's where financial valuation techniques come in. Tools like price to earnings and price to sales ratio offer a good starting point to help estimate a company's intrinsic value. The PE ratio compares a company's stock price to its earnings per share, indicating how much you are paying for each dollar of earnings. A PE of 10 would mean you are paying $10 for every dollar the company earns. A general guideline for PE ratio is anything from 0 to 20 is undervalued, 20 to 25 is fairly valued, and anything above 25 is overvalued. PS ratio, on the other hand, compares a company's stock price to its revenue per share, telling you how much you are paying for each dollar of a company's sale. A PS ratio of 2 would mean you are paying $2 for every dollar of sale the company makes. The ideal PS ratio is typically below 2. However, it's important to remember that these ratios are just a starting point. Financial health, future outlooks, and other factors also play a crucial role in valuation, which PE and PS ratio doesn't consider. Which brings us to the next valuation method, discounted cash flow analysis, DCF in short. DCF analysis is a powerful tool that goes beyond historical data. It estimates the present value of all the company's expected future cash flows, discounted back to today's dollars. This allows you to consider a company's growth potential and value it based on its future earnings. Unlike PE and PS ratios, DCF analysis is more flexible. You can adjust countless key assumptions in the model, such as future revenue growth, profit margins, and capital expenditures, to create different scenarios and assess the company's value under various conditions. The downside of DCF is that it can be very time consuming, taking up to hours, and require a good understanding of financial modeling for accurate results. Hence, here's where I come in. I've done the hard work, so you don't have to. I've created a comprehensive DCF valuation template that allows you to generate a detailed 3-statement financial model with sensitivity analysis in just under 30 minutes. Just fill in the boxes with your assumptions and mission accomplished. Link is in the description box below. Once you've completed the valuation, it's time to incorporate a margin of safety. Remember, stock prices can fluctuate due to various market dynamics. Even the most detailed valuation can't predict the future with perfect certainty. By acquiring a stock at a discount, you create a margin of safety. This provides some breathing room if the company's performance falls short, or if broader market conditions take a turn for the worse. The ideal width of your margin of safety will depend on 2 key factors: your personal risk tolerance and the characteristic of the stock itself. Stable, well-established companies with predictable earnings typically require a smaller safety of margin, roughly 10 to 15%. Conversely, for growth stocks with less predictable earnings due to factors like rapid expansion or new technologies, a wider margin of safety is prudent, possibly 20 to 30%. Remember, these are just rough guidelines, and you should adjust them based on your individual risk tolerance. And finally, the last step of choosing a stock: avoid emotions. Investing is a marathon, not a sprint, and keeping a cool head is key. Benjamin Graham, widely known as the father of value investing, famously once said, "Individuals who cannot master their emotions are ill-suited to profit from the investment process." Imagine getting caught up in the excitement of a hyped-up stock and buying in without proper research. Sure, it might go up in the short term, but what if it crashes the next moment? Emotions like FOMO, the fear of missing out, or the thrill of chasing overnight riches can sometimes cloud your judgment, leading to rash decisions you might regret later on. Instead, take your time, research the company's fundamentals, and understand why you are investing in it. A well-informed and patient approach is the recipe for long-term success. Alright, so there you have it, a powerful 6-step system to help you ditch the guesswork and build a portfolio of winners. Remember, identify your goals. Are you seeking an adventure with high growth potential or stability with steady returns? Once you know your goals, research the companies you want to invest in. Understand their business and how they stack up against their competitors. Don't just chase the hot stock. Secure a good deal by estimating the company's intrinsic value and buying at a discount with a margin of safety. And lastly, don't let emotion cloud your judgment. Investing is a long game, so research patiently and make well-informed decisions to become the stock-picking pro you've always envisioned to be. Let me know in the comments what stocks are you looking at, or what other financial topics you would like to see. Don't forget to smash the like button and subscribe for more insightful content. Thanks for watching and see you in the next video.